Welcome back, everyone. It is 1:42 East Coast time, and the markets over the lunch hour have stock markets, equities indices have steadily deteriorated. VIX is up 16%. Before we broke for lunch, I can't remember where it was. I think it was above 2. I think it was like 5 or 6%. And RVX might have actually even been negative at that time, but VIX on the S&P volatility on the S&P is now almost a 17% increase. The volatility on the Russell is now almost a 10% increase. The Dow is down 350 points. These are the cash markets. Everything but the Russell is down over 1%. The Russell is only down 1/3%, 0.3%. The Dow and the Nasdaq 100 are leading indices down. The dollar is up 12, 13 basis points. Gold is down, crude is down. The futures on the 10-year note are up 35 basis points. So this would be, the way things are headed now, this would be the third consecutive down day in the market. And keep in mind that this is also the beginning of the month of March. So we saw earlier, that the bar on the monthly chart for the month of February is completed now. And this is the first month that the S&P has been down and the Dow has been down since March of 2017. It is also noteworthy that of the 11 S&P sectors, not a single S&P sector escaped the selling. Some were better than others. Information technology was barely lower, but it was lower by a few points. So I can say truthfully that of the 11 sectors, every single one of them was down in the month of February. Some of those sectors had not seen a down. I think it was industrials, or maybe it was basic materials, that hadn't seen a down month, I want to say since May of 2016. So that's particularly noteworthy. The fact that all sectors are down and that some sectors, which were doing quite well, have had their first down month in a while. If I look at, let me find a monthly chart here. It wasn't industrials. I think it was basic materials or materials. The materials sector, no, it wasn't that. Materials sector hasn't seen a down month since May of 2017. I think that was the longest streak of any of these sectors. And you can see now that basic materials is crossing below this trend line. It had not yesterday. It is today. And if we look at, I think I have trend lines drawn for every single one of these. Obviously the information technology, which has been the strongest, has a ways to go before it hits the bottom of its channel. Industrials is closer. Healthcare has a little bit of a ways to go. You could argue that maybe there would be a better way to draw that chart. Financials, consumer discretionary, didn't draw one. No, it did draw one there. Consumer discretionary has a bit of a way to go. Consumer staples is crossing below. Real estate and utilities, I can probably tell you right now, have crossed below. Real estate did that 2 months ago. Utilities has not. It's closer. It's one of the closer ones. Energy is at the bottom there. And telecommunications, which is really more of a coiling play than anything else. I've talked about this before, where if you have two trend lines like this, where clearly the price action is trapped between them and it's getting tighter and tighter as it moves towards this apex, this pricing action is coiling together like a coiled spring, and a lot of times you'll see a break up or down. If that doesn't happen, then it'll just cross over and it'll just uncoil very slowly within the other side of that cross. So we're in for some rough waters ahead. And the thing is that I don't know that the data is necessarily all that indicative of an economy that's in danger of overheating. I don't think that Jerome Powell's testimony really gave investors a reason to be terribly bearish or terribly concerned about the prospect of inflation. In fact, he said the data that he's seeing doesn't tell him that the economy is overheated. So this isn't even a fear about inflation. I think this is a fear of the Fed doing its job, because this Fed has been nursemaiding equities markets for a decade. That's why we've seen the longest bull run in history. And part of the, I mean, yes, they needed to do that. They needed to have an accommodative monetary policy. Otherwise, they would have thrown us into a depression. I get all that. Monetary policy had to be loose for an extended period of time. Now that the Fed is on this rate path, or this path to normalization, stock markets are, equities markets are melting down. And I'll tell you honestly what this is. I think this is an acknowledgement that valuations got too rich. You could argue that, well, with earnings growth, no, valuations are fine where they need to be. You know, I think this is a signal to us that the multiple expansion that we were seeing wasn't quite justified. Again, I'm not saying again. So corrections are not a bad. Now, if you're caught in them and you lose money and you get out and you miss the bounce, then yes, corrections are terrible. But this correction that we're going to be seeing is going to be an opportunity for others to deploy or redeploy their capital and catch the next bounce higher. In preparing for an article that I'm writing for Seeking Alpha, I'm taking a look at, I think, first of all, the correction is inevitable. All right, we're not going to escape that because of the fact that the monthly stochastic crossover tells us that we're going to see more pain. Okay, very rarely do you ever see a bearish stochastic crossover and not have it followed by at least a handful of consecutive months of bearish pricing. If you believe these drawings, so the first one is a price channel containing all the price action from the bottom in 2009 to the most recent bottom at the beginning of 2015, you know, drawn here to containing 100% of the price action since that time. This is the range that the S&P has to be trading within. Okay. Now, if I draw a Fibonacci retracement using the most recent touch of the bottom here, this recent low in February of 2016, and I extend it to this most recent high on the 26th of January, then this is the Fibonacci. This is the drawing that results. And if we switch over to a daily view, And if you believe in this price channel, and if you believe in the theory behind the Fibonacci number, which is that the major level of retracements are the 61.8 and the 38.2, then there's a very real possibility that the S&P is going to trade down to this 2466 level. Now, it doesn't necessarily have to trade down there by April 20th, or late April, which is what this is. So whatever the third expiration is in April, okay, it can just come close. Now, the reason why this area is important is because if it breaks through here, that's a very bad signal. Because now it's potentially it's establishing a new price channel. So breaking down below it, a channel that it has been within for the last decade, would be a bad signal. And then also, for it to break through here, it's breaking a major Fibonacci level of retracement and could conceivably trade down to the 50%, which is a minor retracement level, or down to the 61.8%, which would have us getting anywhere between 23.15 and 22.16. Okay, that would be about a 20% drop. Well, more than that from here. Be about an 8%. To come here would be about an 8% drop from where we are today. Okay, from the peak, it would probably be about a 20% drop, I'm guessing, without actually having done the math. Then it'd be a 14% drop. Okay. A 20% drop would be about here to this 2300 level. That would be 2297. That would be a 20% drop. And you can do, the same exercise, and I will, for the other three indices, for three other indices, for the Dow, for the Russell, and for the NASDAQ 100. So I'm not sure how much I really want to trade this afternoon, only because I'm happy with where I am so far for the day. I mean, on a day when the Dow, when almost all the indices are down anywhere between 1.5% and to 2%, to be sitting on a profit for the day because I shorted the futures a couple of times opportunistically is good. Most investors that are not comfortable shorting are not doing as well. That was about 6 ticks. So it covered the cost of commission and then a little bit. But really, I think what I want to focus on today is just what is this market doing? You know, if we take a look at some time frames here, so this was the open, traded all the way down here, and then it got this big reversal at 8 o'clock. That was about the time that Jerome Powell started testifying before the Senate Banking Committee. I don't know when his testimony ended. I just know that they were still going. They were still going at 11:30 East Coast time with a 10 o'clock start. And then from 8 until about 8:30, 8:40, there was a nice run up. And then a little bit of a reversal. Reversal reversed at 9 o'clock. Traded up, reversed again at about 9:20. Traded down, reversed again at about 9:30. That was when we broke for lunch. We had this little ride up, and then 9:56, 11:56 East Coast time, the bottom just came out. And with the exception of a few reversals here, we've got 3 waves of selling. If you want to call this a wave, I think it is, because it's, you know, basically pretty dramatic. You know, it's not as sustained a wave of selling. This one here is pretty sustained. This one here is pretty sustained. But just noon Eastern, just huge, just these sustained waves of selling. I don't know if this is the concern about tariffs. You know, the Trump administration, what time was it that Donald Trump had? He had a roundtable with CEOs, and he went ahead and he announced. He was coy and said, "Oh, we're not going to announce it till next week." You know, this roundtable of mining company CEOs, steel and aluminum company CEOs that he was having, he just announced it. And that's when the market, if I check the time that news came out, I'll bet you it was right around here, right around noon time. So at 8:51, the most recent news out was that Trump wasn't going to announce tariffs. And then he flip-flopped. So at about 10:20, so it was probably before 10:20 when he actually announced this. I don't know how to go back and see, or I don't know where I would look to go see, but I mean, the bottom line is, we know the reason why. This is all about tariffs. So if you owned U.S. Steel, you were doing okay. You're up 5% on the day. It was up as much as 8%, I think, at one point. But where are we right now? We're this yellow line, which you can barely see here. Again, that's the pivot. That's the midpoint of yesterday's range. We've broken through S1. We've broken through S2. We're on our way to S3. There is an S4. I don't know if I have a way of drawing it. Nah, there's no entry there for S4. So really your best bet, my best bet, is to throw the old Fibonacci on there. And what that would tell us, since we're already below the 50% retracement level, we did see a stop here at 50, or not 50, I'm sorry, the 38.2. So we're heading down to this 61.8. So I'd expect 66, 68 is potentially a level of support. I think a trade down there is pretty safe. I wouldn't get in now. I don't think you're going to get that great a trade location. 61.8 was a level of support here back on the 15th. So it is, you know, the market does remember this. So if you can catch this, you know, maybe it rises back above the 50. I don't think it's going to go all the way to here. It might, but, you know, maybe it rises back above the 50. But if you can catch it on the next stochastic downturn, you know, set a tight, or not set a tight, set a target down here, monitor it, you know, move your stop down as it trades down towards your profit target, simply because this market is very reactionary, and if any piece of data, you never know what news is going to come out. Some headline could come out that could cause the reversal to happen, to have to just rip your face off. You know, you want to protect yourself against that.